Happy Monday, everybody. And I do hope that you all are enjoying your Memorial Day and it's a time of reflection and peace for everybody. This week's missive is going to be kind of a 1-2 punch along with Greg's. And there's a tie back to last week's missive. Last week, I went kind of long. It was one of my longer missives, and I had a lot of charts. And so I thought I would kind of boil it down to some essential points this week and explain the importance and then what it means for us. So, like I said last week, Moody's just downgraded us, the United States government, in their credit rating. Now, they're the third and final agency to downgrade the US dollar. It was the S&P credit rating. They downgraded the US in 2011, and then Fitch downgraded the US in 2023. So now that Moody's has done it, they were kind of the last straw, and now they've downgraded. And what does the downgrade mean? It think of it in terms of you and me. If your credit is downgraded, it means that there's higher risk in you not paying back your loans. What does that mean for you practically? Well, if you have a lower credit rating, you want the highest credit rating you can get, right? So you can have the lowest rate interest for mortgages or car loans, so that when you're borrowing money, you pay back the least amount of money you need to. Well, that's what the United States government is doing. And they've always been the tier one asset, the safest place you could put your money because, no sweat. The US is going to pay back their debts. Well, what does that mean? Well, you're not going to get a whole lot of interest because there's just not that much risk. Well, now all three credit ratings agencies are recognizing that the risk is increasing. Why is it increasing? Because our debt continues to climb. Even with this new administration, our US debt continues to climb, our interest continues to climb, and there's a risk that we won't be able to pay it. What does that mean for us? Well, the credit rating was downgraded, which means that now when we borrow money, we have to borrow it at a higher interest rate, which is hard for cash flow because then the United States has to pay more interest if they want to borrow that money. Here's the other thing. When countries are loaning money to other countries, they're not necessarily doing it for the interest. They're doing it to keep their money in a safe place. Right now, there's not a whole lot of demand for the US treasuries from other countries. So where are they putting their money? Gold. That's where this breaks down for us. Gold continues to rise, and it's not because individual investors are investing in it. I mean, individual investors are a little bit, but when we've been seeing the price of gold move up, it's because the central banks have been moving their reserves into gold because they want to know that if they need their money converted back to liquid so that they can spend it, they want to know it's safe. And so money is moving into gold faster than it's moving into US treasuries. So last week's missive, that's really what this comes down to. Now, if you're an investor with us, you have gold in your portfolio. And this is why. The future of gold will continue to go up in price. And it's because it's boring, it's safe. When people want to store their money in something that they know is going to be there, it goes to gold. So, and not just gold, other hard assets, but gold's kind of the primary one, especially when it comes to the central banks. So, all right, with that, you all have a great rest of your Monday. Have a great week. We'll see you next week. Bye-bye.